U.S. rates are holding a narrow range as August gets underway. Focus on the Fed's commitment to continue increasing rates will define this weekend Kashkari's comments that have set the tone early. Specifically, he noted that we are committed to bringing inflation down and we're going to do so with what we need to do, adding that we are a long way from achieving an economy that is back to 2% inflation. This is consistent with the FOMC's hawkish stance. Moreover, it suggests that despite the two consecutive quarters of negative GDP, formerly known as a recession, monetary policymakers are on track to bring federal funds up to 3.25 to 3.5% range or beyond. Suffice it to say that there's a lot of economic data between now and the September 21st FOMC meeting, a fact that will leave this debate between 50 and 75 basis points topical in the weeks to come. That said, there is nothing on the macro horizon that would suggest that the Fed's hawkish commitment is in danger. In fact, we suspect this week we'll see further official commentary consistent with Kashkari's emphasis on a 2% inflation target. Our assumption for the Fed is that decades-high inflation will similarly require a degree of hawkishness not seen for decades. Moreover, the nuances of monetary policy in 2022 versus that of the 70s and 80s are countless, not least of which being that the overall lower level of outright yields. Said differently, a greater than 4% terminal rate during this cycle would have a far different economic ramification than it might have in the past. Record low consumer confidence, spending rotating from non-necessities into necessities, and increasing employment angst speak to the fragility of the outlook at this moment. It's difficult to imagine the Fed not pushing rates at 3.25 to 3.5, although the extent to which investors are anticipating the Fed will be cutting in 23 is striking.